Hello, investors. In the last session, we learned in detail about the non performing assets, that is the NPA, which are very common these days. As mentioned in that session, here we will learn about the provisioning of the NPA, which is also vital in understanding all aspects of NPA as a whole. As per law or rule books, the banks or financial institutions are required to set aside a portion of their income as provisions for the loan assets, which serves as contingency for losses that may arise in the event of non recovery of these loans. The amount of provision to be kept depends on the probability of loan recovery, which we will learn in detail with a simple illustration. So, on the screen, you can see the loan details of a bank, say BB Bank. So, you can see here the total loans, or otherwise called the total advances, is 1 lakh crore. The standard loans are 96,000 crore, out of which the direct agricultural and SMB standard loans is 20,000 crore. So out of the 96,000 crore, 20,000 crore is of direct agricultural and SME standard loans, and the rest is others. So again, the substandard loans, we mentioned it is 1,600 crore, and 400 crores is unsecured standard loans, as in there is no collateral available for those loans. The other loans are secured loans wherein there is a collateral available for recovery in case of a default. And again, doubtful up to 1 year, D1 is 1,600 crore. Doubtful above 1 to 3 years is D2, that is 400 crores. Doubtful above 3 years, D3 is 240 crores, and the loss assets is 160 crore. So here all the doubtful loans are fully secured. Secured as in there is a collateral available against that. Now let us get into the provision calculation for standard account. So here the standard loan is 96,000 crore, out of which I explained 20,000 crore is direct agriculture and SME standard loans, and other standard loans are 80,000 crore. So for direct agriculture and SMB standard loans, the provisioning percentage as per rule is 0.25%. So 0.25% of 20,000 crore fetches you 50 crore. And for other standard loans, the provisioning is 0.4%. So that gives you 320 crore. So the total provision for standard accounts is 50 plus 320, that is 370 crore. Now next, getting into provision on substandard accounts. So substandard accounts as per the loan book is 1,600 crore, out of which the unsecured loans are 400 crore, and rest 1,200 crore is secured loans. So secured, unsecured, you are now aware how and what it is. Now the provision for unsecured loans is 0.25%. The percentage is higher than secured loan because you don't have a collateral against that and the risk is high there. So as the risk is high, the provisioning percentage also goes up. So here it is 0.25%, and 0.25% of 400 crore fetches you 100 crore. And for secured loan, the provisioning is lesser than unsecured loan, which is 0.15%. So that fetches you 180 crore. So the total provisioning for substandard accounts of 1,600 crore is 100 plus 180, which is 280 crore. Now the next session is the provisioning for doubtful accounts. So D1 1,600 crore, D2 4,000 crore, and D3 240 crore. So D1 is having a provisioning as per rule of 25%, which fetches you 400 crore. D2 40% provisioning, and D3 100%. So that fetches you a total sum of 800 crore as a provision for doubtful accounts. Now the last is the provisioning on loss assets. So loss assets, as I mentioned, the complete amount of loan, that amount is equal to the provisioning amount. So 160 crore was the loss assets. So the provisioning amount for that also is the full amount, which is 160 crore. So now we get into the total provision for NPA accounts. So total provisions for an NPA account is derived by total provisions we calculated here minus the provision for standard accounts, because standard accounts is not categorized under an NPA. So from the earlier slide, you got the total provisions of 370, 280, 800 and 160 crore, of which 370 crore is the provision for standard accounts. So you subtract that and you get a total provision for NPA accounts of 1240 crore. Now another important ratio here in provisioning is the provision coverage ratio, PCR. That is nothing but the total provision for bad loans, that is NPA, divided by the total bad loans, which is again otherwise called the gross NPA. So here this NPA and bad loans are like same meaning only. So again substituting the values, total provisions for bad loans we have computed as 1240 in the last slide. To make it percentage, we have to multiply with 100 divided by the gross NPA is 400 crore. So this 400 crore is nothing but the sum of substandard loans plus the doubtful assets plus loss assets. So this will fetch you the total gross NPA. So if you put that in the denominator with the numerator as the total provision for bad loans, which is 1240 crore, which will fetch you a 31% provision coverage ratio. So the gross NPA, which is another important measure in NPA, is computed by gross NPA divided by the gross advances. So gross NPA here is 4000 crore, which we mentioned in the last slide. Again, to make it percentage, we have to multiply with 100 divided by the gross advances is nothing but the total loans or the total advances or the gross advances, which is 1 lakh here, which you got from the earlier slide of loan details for BB Bank. So that is computed as 4%. Now this gross NPA on year is desirable to be reducing from year to year. Like in 2020, you had a gross NPA of 4%. Now it has reduced to 3.5% in 2021, and say it reduced to 3% in 2022, like that. So it is ideal that you keep on reducing the gross NPA, which is showing the effectiveness and efficiency of the bank which you are analyzing. Now if you see this chart here, which is the gross NPA of public sector banks from year 2018 to 2021 in India, the value is in trillions. So it was higher in 2018. So you can see there is definitely improvement over the years. In 2018 it was 8.96, in 2019 it is 7.4, and it has reduced to 6.17 in financial year 2021. So there has been a reduction in MPA in the public sector banks. So that again shows the effectiveness and efficiency of the banks and the administration or the government as such. Now coming to the net NPA is the gross NPA minus the provisions. So here the net NPA can be calculated. So here the net NPA is 4000 minus 1240, so which will fetch you 2760 crore. Percentage of net NPA equals net NPA divided by net advances into 100 to make it percentage. So here again the net NPA is 2760 crore into 100 divided by net advances is total loans, which is 1 lakh, minus the provisions for NPA, which is 1240 crore. So that will give you 2.795%. This is the percentage of net NPA. So more the provisions, more the expenditure for the banks. So it is desirable that the bank goes for good loans or bank keeps lending to quality companies wherein the company is having good collaterals and is owning a good business and a good management, wherein the management always takes loans or debts which are manageable by them and that which they can repay from the profits they generate over years from the business they are funding the debt with, so that there is no non performing assets and all the assets perform very well and interests are paid on time and there are no defaults. I hope this session has given you a practical and clear idea on the provisioning for NPA. So in the next session, we will discuss on another important element which is linked to this NPA, which is the NCLT, NCLAT, and asset reconstruction companies. Happy investing.